If you can fully understand the concept of this video, I'm pretty sure you won't ever look at the world the same way again, especially the options world. Welcome back, mindful investors. In this video, I'm going to talk about the #1 misconception of the options market, especially when you're buying options. A lot of beginners, after they buy a contract of a certain strike price, they may think that they're only profitable only when the stock price reaches the strike price. But that's not true at all, and I'll show you in a couple examples. I don't have that many long positions, as you can see here. Most of these are in the negatives, which means I'm selling the options, but I do have a couple on Nio and PLTR. As we look at Nio's stock price right now is at $41, but yet my put option for $35 is in the money. It's in the money for about 40%. I bought it for $3.12, now it's at $4.45. Why is that? And in contrast, we have these $30 Nio puts, which is in the losses. Both the strike prices are below the current stock price. So why is one profitable and the other isn't? We'll look at one more example here for PLTR. We have a very long leaps here for $35 calls. The stock price right now is at $27. So there is $8 of differential there. But why is this call option profitable? We'll explain this concept with this analogy. So this analogy here is throwing a ball. We throw a ball up, it says a lot of things. It says so many things about the options market whenever you throw a ball. You can throw it high, you can throw it sideways, you can throw it straight up, you can throw it a little bit diagonal, you can throw it a little bit flat. All of this says something about the options market. And we'll explain this through a couple concepts we learned from Physics 101. So we can draw axes here, and then we're gonna draw a little projectile, like how we threw the ball. So it's a curve that goes something like this, right? For the axes here, we'll put in time and height. And then we'll show a concept. It's called vectors. Vectors is a force that has a direction and a magnitude. Any moment of time along this projectile, we have a vector that kind of goes along the curve. So we have something like this here, like that here, and then here and here, like this. So why does all this matter? It matters because all these vectors can be broken down to vertical and horizontals. So these verticals and horizontals. So something like here up front, we have a lot of vertical and some sideways, right? Well, the sideways portion doesn't really change, but the verticals, they tend to decrease over time. Like right here is already flat. There's no vertical. There's zero vertical here. And why is that? Because there's always gravity going down. Gravity. If you can visualize all this, and how it relates to the options market, then I believe you're well ahead of the game. Because of the second concept, momentum. So something like this here, it has a lot of momentum going up, while something like here is minuscule going up. And right here, the stock will tend to go sideways or even downwards. So the stock is kind of running out of fuel. And when it's running out of fuel, what's next? It tends to go back down, right? So what's the takeaway from all this? Is that if we can identify where the stock is currently, then we know what kind of plays we're gonna make. So after seeing those two concepts, we'll look at the Nio example again and see why one of the contracts are profitable and the other isn't. Okay, the first position here is Nio at January of 21, $30 put. And the second one is February 21, $35 puts. And this one is in the money, this one isn't. Okay, and I'm gonna extend this timeline right here a little bit further out. So we have November, December, January, February. So this line is kind of to scale, February here and Jan here. Okay, now we'll look at the momentum of the stock. Right now is in the downward trajectories like this. Right now like this. And hypothetically, if it continues in this trend, what price will the stock be at? That's the whole momentum concept. If it continues in this trend, will the stock hit your target strike price? That's the ultimate factor to determine if you're profitable or not. And in a hypothetical case, right here in January, we have about like this line right here. So it may hit the $35 mark. And since my strike price is at $30, this is why the contract is out of the money. It's in the losses. Our February contracts are in the money. So if we draw a straight line and straight across here, we have about $24. So $24 here and $35 here. So this $24 is much lower than my $35. So that is why this contract is in the money. Everything we just talked about are very dynamic and it can change from day to day or week to week. For example, if Nio somehow comes out next week and they say they have the ultimate partnership with Tesla, saying that they would swap their batteries, at an instant, all this changes. And next week, everything shoots up. The stock price shoots up. The momentum switches the other way around. So all of this will definitely be in the hole. And one day it will just go down 70, 80% because of this main driver. The momentum has switched. That is the ultimate driver for option prices. So what do you think? Have I changed the way you look at the options game through all my examples? If you found any value in this video, drop a like, comment, subscribe, because it really helps out the channel. Thanks again for watching, take care, and I'll see you in the next one.